Good afternoon. Welcome to the SIA Wealth April 2023 Market Outlook webinar. I'm Kyle Wilson, Portfolio Manager here at SIA Wealth, and I'm joined by Chief Market Strategist Colin Cieszynski. In this webinar, I'm going to do a quick Q1 review of some SIA Wealth managed portfolios, including some positioning and performance as of the end of the quarter. Following that, Colin will share his market insights with some charts and tables on a few macro topics that are relevant. So today we'll have a look at 4 equity-related portfolios that SIA Wealth sub-advises for BMO Global Asset Management. Speaking just to the quarter overall, on a broad basis, we saw markets rallied in the first half of the quarter, which was led by mostly growth stocks. However, sentiment did turn down in late February as some more hawkish talks from central banks slowed down the markets. We saw this weakness accelerate into March with stresses in the banking sector, which briefly eroded investor confidence, affecting several sectors, namely financials, which had reasonable performance through January and February. Across our portfolios, we did see slightly negative to moderately positive performance. A few portfolios lagged broad indices for the period, largely as a result of January's rally, with the portfolios having little to no exposure to leading sectors like technology and consumer discretionary. However, we have begun to add these sectors into the portfolios throughout the quarter. Across February and March, we saw the portfolio more in line. March was largely adversely affected by some financials exposure, not specifically regional banks. However, the entire sector did see a bit of a pullback, which was a leading sector since December of last year. And the majority of these holdings were removed in March as well. Despite recent absolute performance, I will also discuss some longer-term risk-adjusted metrics per Morningstar, which suggests that the funds continue to deliver attractive longer-term risk-adjusted returns. And lastly, I'll mention that all the portfolios are still currently maximizing equity exposure, and we continue to monitor relative asset class positioning, and we'll adjust portfolios should we need to do so. So first, taking a look at the BMO Tactical Global Equity ETF Fund. At the end of the quarter, the portfolio's highest sector weight was industrials, followed by technology, two sectors that were seeing high relative strength recently. Performance was near flat for the quarter, with contributors coming from stocks in the technology sector, specifically electronics and semiconductors, as well as computer hardware. But given the portfolio was slightly underweight to this sector in January, this only had a modest effect. Exposure to some brokerages and insurance companies adversely affected the portfolios in March, as the sector was pulled down over a couple of days, leading to some positions being sold out. Despite the tough quarter, over 3 years here, we can see the risk-adjusted returns are still competitive. Obtaining a 2.37 alpha versus the category minus 1.29 and a 0.81 Sharpe ratio, which is in line with the category average. The fund also maintains a low risk rating versus the category in the global equity space. Next, taking a look at the BMO Tactical Global Asset Allocation ETF Fund. We saw a slight positive return for the quarter, with the bond side performing relatively better than the equity side. From a risk standpoint, the portfolio maintains a better than category average alpha, albeit still slightly negative, with a Sharpe ratio that is still above category average. The fund continues to deliver competitive risk-adjusted returns over the longer term. With regard to the BMO SIA Focused North American Equity Fund, we saw a slight negative return for the quarter, with modest contributors again coming from stocks in the technology sector, specifically electronics and semiconductors. This portfolio also had little to no exposure to technology and consumer discretionary in January, which these sectors rallied. This contributed to some relative underperformance. And also, we removed non-bank financials in March during the sector weakness. On a risk-adjusted basis, the portfolio maintains a positive alpha of 4.14, much higher than the category average of minus 2.73, and a Sharpe ratio of 0.81, which also exceeds category average. This fund also sits in the low risk category while delivering average returns, once again highlighting that the risk management aspects of our tactical approach. And the last portfolio I wanted to cover is the BMO SIA Focus Canadian Equity Fund. This was a bright spot in the lineup, delivering a 5.65% return for the quarter. This was really due to contributors in the industrial sector, such as Bombardier and Stantec. We did see detractors from the portfolio coming from sectors like energy and technology. However, over 3 years from a risk-adjusted basis, the portfolio also maintains a category-beating alpha, but a slightly lower Sharpe ratio than the category average. And with that, I'm going to flip it over to Colin to provide some of his market insights.
Kyle, my name is Colin Cieszynski, Chief Market Strategist with SIA Wealth Management. I'm going to speak now to some of our market insights that we've based on the changes in relative strength and market action over the last month or so. We're going to look at inflation and interest rates, sector rotation in equity markets, what's been happening with capital flowing in and out of defensive havens, international equities, and some other areas. So one of the first things I wanted to talk about is a theme that we've been discussing for well over a year now, which is the gap between U.S. inflation and interest rates. And what we had seen even a year ago when rates started going up was there was a huge gap between where consumer price inflation was and where the Fed funds rate was. And we'd always felt that at some point they'd eventually meet in the middle. And the low for Fed funds was of zero, almost zero, and the high for CPI in the States was just over 9%. And this month they finally met in the middle at 5%. U.S. consumer price index has come down to 5%, and the high end of the current Fed funds rate is about 5%. And what that means is that the Fed now is finally at a position where they could either start to basically pause their interest rate hike program. They may do one or more increases, but at this point in time, they're getting pretty close to the end now that inflation and interest rates have finally met in the middle. And in Canada as well, the consumer price index has been falling. And at its meeting last week, the Bank of Canada outlined its forecasts for inflation going forward. And they basically said they think inflation can come down in Canada to 3% by mid-year and to 2% by the end of 2024, which is the orange part of this graph. The blue line is consumer price inflation to date, and the gray line is the Bank of Canada's overnight rate. So the Bank of Canada's overnight rate has been on hold for a few months now, and inflation has been coming down, and it's getting close to the crossover point. It's not officially there yet, but it is getting closer. And so because of that, the interest rate hike cycle appears to be getting close to an end. We've seen a number of central banks raising interest rates and over the last year or so, but with interest rates finally catching up to inflation, we seem to be getting close to the end of that. And why is that important? And there's a couple of things. What we'd seen in 2022, the story was about tightening and the pulling back on all the liquidity that had been sloshing around out there had dragged down on the markets. And a lot of people think, well, once the central banks stop raising interest rates, well, life will be great again, and rates will come down quickly, and they'll flood the system with money again, and so on. That's less likely to happen. First off, and because the quantitative tightening process that we're in is likely to go on for several years. It took the dramatic increase in the size of the balance sheets of the central banks to you can't take that pull that down quite as fast, because if you did, you'd most likely cause a recession. And they don't really want to do that. They want to kind of be able to do this over a number of years. But what's important in the past is that interest rate peaks have not necessarily coincided with bottoms of the market. In fact, the bottom of the market has often come later, and we've seen this in the last three cycles. The peak of Fed funds in was June of 2000. The market actually peaked after the peak in December 99. The Dow Jones did not bottom out until September of 02. June of 07 was the peak for Fed funds. The stock market peaked in October of 07. Dow Jones did not bottom out until March of 2009. The last cycle was faster. The Fed funds peaked in April of 2019, and at that point it was above the CPI just barely, but it was. The Dow Jones peaked in December of 2019. Dow Jones bottomed out in March of 2020. Due to the pandemic, that bear market was substantially accelerated. And so why is that? Well, because at the end of the day, tightening to get down inflation usually means you have to slow the economy. And if you slow the economy, then that has an impact on corporate earnings and on corporate liquidity and things like that. And one of the big questions we really have moving forward now is, with the central banks now pretty much done raising rates, are we headed for a soft landing or a hard landing? And the jury's still out on that, but we will explore that a bit over the next number of slides. First, I wanted to revisit our seasonality chart once again. It's an interesting one. In December of 2022, we had a worse than expected December, a worse than average December. And the reason for that was because of tax loss selling. There was heavy tax loss selling because so many investors had tax losses to take advantage of. January then saw the rebound, and we had a much stronger than historical average rebound in January, and that was the lifting of the lid and the offsetting of the previous month's tax loss selling. And so a very strong New Year's rally. February was a rough month for markets as the central banks, kind of, Fed in particular, started to talk hawkish again. March, even with the banking crisis and even with the uncertainty, turned out to be better than historical average, which are the blue bars, and almost as good as last year, which are the red bars. In 2023, April so far, we've seen that April of 23, the green bar, is substantially better than April of 22, the red bar, but not quite as strong as the blue bar, which is a historical average. Now, to be fair, though, the green bar only covers the first half of April, so there is time for that to catch up to the blue bar. We'll see what happens. Historically, we should note May and June are kind of historically softer months of the year for the markets. Now, we're getting a good rally through earnings season. The question is what happens after earnings season, and what happens if the Fed at one of its upcoming meetings says they're ready to pause rate hikes in a statement or in a decision or what have you. So there's some moving pieces, but we should be aware of that May and June historically are not quite as strong months for the markets. July is historically a rebound month, and then August, September, and the first half of October are historically the weakest time of the year for stocks. So we are kind of moving now from a historically stronger time of the year for stocks into a historically weaker time of the year for stocks. Breadth has been interesting to date. So we've seen some significant moves, and over the last month or so, most sectors are now up. The one exception has been real estate. If we look year to date, the strongest sectors so far have been technology, industrials, materials, and consumer staples, and also communication services. The weakest sectors, no surprise, financials. Energy has been soft with the oil price down quite a bit, especially from a year ago, and real estate has struggled. So there is some mix, and there has been some changes in leadership in the market over the last number of months, and which has created some significant opportunities in terms of relative strength. And a transition. There has been a significant transition, as well as some sectors have fallen out of favor and other sectors have come into favor. We are going to take a look now at a few sectors. First, we're going to start with the financial sector. Within the financials group, the strongest area, which is the gray line, has been Canadian banks. And Canadian banks in February, March did not come down as much, and they have quickly recovered their losses. The insurance and brokers are the blue and orange lines. They had fell off to a moderate extent and have been kind of slowly but surely recovering a little bit at least. The black line at the bottom is regional banks. They've continued to struggle. The purple line is national banks. They also have continued to struggle. Although since their earnings started to come out last Friday, and particularly as we've moved into this week, the depressed banking sector is starting to do a little bit better because their earnings were not as bad as people had feared. That sharp sell-off and continued declines up to earnings suggested some pretty low expectations for earnings from that group. And with the results coming in better than feared, we have started to see a bit of a rebound. The technology sector, meanwhile, as I mentioned, has been leading year to date, and it has continued to attract fairly sizable interest from the markets. The one area that's been a little bit soft at the blue line is the social media stocks. They've been more up and down and continue to be going that way, whereas the upper lines are things like technology, software, semiconductors are the lines up at the top. Another area we like to look at and compare is the Dow indices, the industrials, the transports, and the utilities. Looking at the gray line, which is the industrials, have kind of been steady over the last 6 months or so. There was a bit of weakness in February, March with the banks and energy sectors coming off, but they've since bounced back March into April. The utilities as well. The utilities had some weakness in February, particularly when the Fed was talking hawkishly and they might have to raise rates even more. But since then, in the last month, as that kind of has gone away, and it's become clear that the Fed's probably close to the end of their hiking cycle, utilities have bounced back quite significantly. We also look at the orange line being transports as an indication of general demand in the economy. And we saw some really great strength to start the year, but transports have been weakening since about the middle of February, which does raise a concern that people might be getting a little bit more worried about the health of the economy. And we're seeing this a little bit in what I call the risk markets as well. This is when people are feeling aggressive. This is the markets people go to when they're looking to take on risk, when they're looking for returns. The gray line that's shaded is the S&P 500 as a benchmark, where the NASDAQ has been running a little bit above that, and we've seen that emerging markets have picked up more recently. However, small cap stocks in the States, measured by the Russell 2000, have continued to struggle. The area that's done the best has been the black line, and that's Bitcoin. Cryptos have come roaring back to start this year. But the question is, at this point, looking at that, is how much of that is that people were willing to take on risk? How much is cryptos were incredibly depressed at the end of 2022? And how much is demand for alternative currencies? With the banking crisis has reignited demand for alternative currencies, and I'll show this on the current slide. And in fact, with the defensive havens in particular, we've seen a move back into alternative currencies with confidence in the banking sector being rocked in February, March. In particular, we have gold, which is orange, has absolutely exploded, but we've also seen silver pick up. And we've also seen the Japanese yen pick up. And that's been most interesting because historically, gold and Japan, the Japanese yen were fellow travelers. When people were worried about anything, then gold and the yen would go up together. When people became more confident, they'd go down together. In 2022, that relationship broke, and that was because the Bank of Japan stayed dovish longer than everybody else, and that sunk their currency and broke that relationship. Well, that relationship now appears to be coming back. Another thing we've been looking at is the U.S. dollar versus the S&P 500 index. A rising U.S. dollar tends to have a negative impact on corporate earnings, both in terms of U.S. exporters, because then their products cost more money abroad, and also for large multinationals, when they repatriate the earnings from their overseas subsidiaries, they come back as smaller when the U.S. dollar is higher. And so what we've seen over the last couple of years is during periods when the U.S. dollar has been strengthening, which is the gray and black lines up top, the orange line, which is the S&P 500, has tended to go down. When the U.S. dollar has come down, the S&P 500 has tended to go up, and it's continued into 2023. When the Fed was talking hawkish, the dollar went up, the market went down. When when the banking crisis hit and people realized, well, the Fed probably can't raise rates much more, the dollar came down and the S&P 500 went back up. Now we're going to take a look at the US versus Canadian and international equities. Canadian equities have been fairly similar to the US, but we've seen some definite strength in overseas markets this year, particularly in Europe. Europe has been quite strong over the last number of months. And this is another chart that I've been following for quite some time, the price of crude oil versus energy stocks. So we've seen crude oil and energy stocks are another group of what we call fellow travelers. They historically tend to trade in the same direction. A huge gap opened up between them last fall where the price of crude oil came down and the price of energy stocks went up. And this is because even though oil came down from 120 to 80, those prices were still pretty good for energy, the earnings of energy producing companies, and that helped to keep the stocks up. Plus, the stock market kind of came back as well. So the orange line is energy producers, the blue line is oil and gas service stocks, and the gray line with black arrows is the crude oil price. Since the beginning of this year, crude oil is kind of flatlined. And we've seen this gap being closed by stocks slowly but surely drifting their way back down, getting pulled down by the crude oil price. The service companies we've seen has been a little bit more volatile in terms of that. The service companies rallied later, but they've also come down faster. The SIA charts equity action call has remained positive. It has remained in the green zone. It's come down within the green zone in recent weeks, but it is still in the green zone. And based on that, SIA Wealth portfolios have maintained their 100% allocation to equities. But as Kyle mentioned, we have changed our weightings in relative weightings across sectors as different areas have taken leadership. I also wanted to continue to note here our tactical changes over 2021 to 2023. We've been much more tactically active, and we had elevated risk signals start in the middle of 2021, which amplified through 2022. And so over 21 and the first half of 2022, we went from 100% equity to 0% equity. As the markets became volatile and we saw a number of swings over the summer of 22 and the fall of 22, we did at different times apply partial positions in equities, and then when the risk increased, we did remove them. Since November of 2022, we moved from 10% equity to 50% equity to 100% equity, and since then, SIA Wealth managed portfolios and sub-advised funds have remained at 100% equity. We will, and based on that, at this point in time, we remain in a market that, as we've seen from the slides, that there have been significant differences in relative strength, significant changes in leadership, and because of that, that does advocate and support the relative strength investing, tactical investing, taking positions, but being prepared to shift to either manage risk or to seek out opportunities as they present themselves. So this here, or just close to wrapping up, is our fund codes and sales information for the funds that SIA Wealth is a sub-advisor for BMO Global Asset Management. And finally, we'll wrap up here with our disclaimer slide, which I'll just leave up here for a few seconds, and we will complete here. So we thank you all very much for joining us this month. And if you have any questions, please contact your usual SIA Wealth contacts or email us at siateam@siawealth.com. Thank you very much and have a great day.